Good morning, everyone, and welcome to this Kepler Trust Intelligence event on small caps. So investing in small caps has long been considered one of the best ways to outperform over the long run. But that hasn't really been true for the last four years or so, really since the end of the pandemic. Large caps have had a good run of performance in most major geographies. That obviously leads to the question about whether this is a good opportunity in the reversion to a longer term trend. And it's worth noting that you can get access to a lot of investment trusts investing in small caps on double-digit discounts at the moment. So with that in mind, we'll be speaking to a number of managers investing in small caps in different markets. And the best place to start is with a truly global portfolio. And today we'll be hearing from Nish Patel, manager of Global Smaller Companies Trust. It's one of very few trusts to invest in small caps with a global remit, and the shares currently trade on a 10% discount to NAV. So as ever, we have 25 to 30 minutes or so for the presentation and 15 minutes or so reserved for questions. Please put your questions in the box on the side of the screen and I'll put them to Nish at the end. So Nish, over to you.
Thank you, Thomas, and good morning, everyone. So my name is Nish Patel. I have recently been made lead fund manager of the Global Smaller Companies Trust, which is an investment trust with almost £900 million worth of assets invested in smaller companies worldwide. I thought today it'd be a good idea for me to really go through three different areas. For those of you who are not that familiar with the Global Smaller Companies Trust, I'll provide you with an overview. And then I will talk a bit about why I think it's a good time to be looking at smaller companies. And then finally, we can talk a bit about activity on the portfolio. So perhaps I'll start with the philosophy of the Global Smaller Companies Trust. The philosophy is very simple. We take a long-term conservative approach to investing in good quality businesses, but we do this in a very opportunistic way. We look to buy into these businesses when they're temporarily out of favor and when they're available at an attractive valuation. The differentiators of the Global Smaller Companies Trust, well, I think it has to start really with the people that are behind the trust. So this is a very well-resourced investment team, and it has a lot of experience. The average experience across the team per team member is about 20 years. So the team has been through a number of different market events. It's been through recessions, it's been through bear markets, bull markets, bubbles, pandemics, wars, a whole host of different areas that have created uncertainty, and it's navigated through those times successfully. The investment team take a approach that is conservative in nature, and we look to manage risk throughout our investment process. That is different. The reason why we've done this is because smaller company investing is risky by its very nature. The attraction of smaller companies are that they do grow quickly, but the problem is they tend to have higher levels of risk compared to larger companies. More things go wrong with smaller companies than with larger companies. So what we want to offer our clients is the faster growth potential of small caps, but to do so with lower levels of risk. The way that we manage risk is we focus on quality businesses. And we also want to buy into these quality businesses when they're available at an attractive valuation and where there is a margin of safety. So if we're wrong in our analysis, then there is a cushion for us to where the loss can be absorbed, and we can protect capital for our clients. The second differentiator for us is that we are truly long-term investors, and being in an investment trust structure is helpful for us to be long-term investors. We offer our clients developed market equities, but also the faster growing emerging market equities as well. And this is all done in one vehicle. So this is truly a one-stop shop where clients can have access to the very best small cap opportunities across the world. We pride ourselves on our dividend. Our dividend has been growing for 53 years consecutively. And this is testament to the companies that we invest in, which tend to have strong cash flow generating capabilities. This is truly a small cap product. So with £859 million of net assets, we're a good size in the sense that this is a investment trust with sufficient scale, but at the same time, it is not so big that we have to venture into mid caps or even large caps. We can be truly small cap investors with the size of assets that we have. And we also take our responsibility towards the discount very seriously. We have a policy of maintaining a discount of 5% or less in normal market conditions. And the way that we manage this discount is through buying back our own shares. And we have been very active in buying back our own shares in the last year or so because our shares have been trading at a discount to their NAV, to its NAV. So I'd like to perhaps talk a bit about what makes a quality business for us and what we look for in a particular investment. So Thomas, if you turn to slide 5, I think that would be a good place to go. So this is what we look for in a holding in the trust. When it comes to quality businesses, we want to invest in businesses where we have a high degree of conviction in what the business might look like in 10 years' time. The business has to be understandable to us. We have to know where the risks are likely to come from, how to value the business, and to have a high degree of confidence that the business will be resilient. This automatically rules out a large part of our investment universe, which is typically loss-making in nature, or where we don't understand the company's products or services, and we can't value the business. We like businesses with really strong competitive advantages. This could be a business that has a differentiated product or service, or it is a business with a very low-cost position, and it's able to pass that low-cost position on to its customers in the form of lower prices. And those advantages are sustainable. Most of our businesses generate lots of cash flow, which is good from the perspective of it indicates good accounting quality, and the management teams can use the cash flow to generate further growth. Pricing power is very important, especially in an environment where inflation is higher than it has been in the past. It's important to invest in businesses that have got a good pricing power. The companies we invest in tend to operate in industries that have barriers to entry because this allows the companies to generate higher returns for longer. Financial strength is particularly important, especially when interest rates are high. We want companies with low levels of leverage. And this also means that the business is able to withstand difficult times. Diversification is particularly important for smaller companies. We want to invest in companies where there is a diversified range of customers that the company sells to. There is no reliance on one particular customer. And the company is not reliant on one particular product or one particular supplier either. When it comes to management teams, first and foremost, the management team have to have a strong track record of allocating capital very well, because this is what generates growth over the long term. They have to be capable operators. There has to be very few operational surprises from day-to-day operations. And we like instances where company management teams own a lot of the company themselves, i.e. the interests are aligned between ourselves and the management teams. We especially like a situation where we're partnering alongside a founder who still owns a large chunk of the business, because then we are truly partnering with somebody for the long term, and everybody's incentives are aligned. And things often go wrong, particularly in smaller companies. So when things do go wrong, we want our management teams to be honest and transparent with us and own up to their shortcomings. So that's what we think is a good quality business. The problem is the stock market, it does tend to know which businesses are the good quality businesses, and the valuations tend to be quite rich for these businesses, and they tend to be quite highly valued. So we are fully cognizant that a good asset is not necessarily a good investment if you are buying into that asset at too high a price or value, too high a valuation. So we look to buy into these companies when they are temporarily out of favor, and when they're available at a discount to what they are intrinsically worth. Because this means that our downside can be protected, and we can potentially earn high returns in the future as the company's shares migrate towards the value of the business. We will use a whole host of different metrics to value the business, such as multiples of earnings or cash flows, or balance sheet multiples, private market valuations, discounted cash flows. We will use a whole host of different metrics to value the business. We turn to slide 6 on this. So if we're doing our job well, it will really show up in the numbers. And here you can see that the average company in the portfolio versus the average company in the benchmark has better quality metrics. Those are defined by gross margin, operating margin, and return on equity. And it also has lower levels of leverage. At the same time, we're offering this to our clients at attractive valuations. So the average company in our portfolio has a lower earnings multiple and a higher dividend yield than the average company in the benchmark. So I'd like to talk a bit about the small cap opportunity today. I do think there is an incredible opportunity in small cap equities. This asset class has a history of doing really well over the long term, but right now it is really unloved, and I think therein lies the opportunity. So I'd like to share some slides that would talk a bit about the small cap opportunity today. So Thomas, if you turn to slide 17. So here we can see that smaller companies, the top chart shows you smaller companies as a percentage of the overall stock market. Now, historically, smaller companies have outperformed larger companies because they are inherently faster growing businesses. And at the same time, a lot of these businesses aren't very well known by the market. So as they are discovered, they tend to re-rate in valuation. Historically, the stock market, this is the US stock market in this case, has been between 7 and 8% of the overall total stock market. So smaller companies have been 7 to 8% of the overall total stock market. Given the level of underperformance in recent years, that number today is 4%. What's interesting about the 4% level is that historically that has been a cyclical low, and it's been the start of a recovery in the smaller companies market. If we look back over the last over history, we have seen that when you've had the recovery from the 4% level, the recovery cycles can be quite long. The two time periods that are most similar to today are the early 70s, which is in the aftermath of the bursting of the Nifty 50 boom, and the late 90s after the technology boom. Both of those periods were signified by narrow leadership in the market. In the Nifty 50 era, it was characterized by the dominance of the so-called one decision, highest quality businesses that were bid up to very high valuations. And in the late 90s, the technology sector did extremely well, and the valuations of those businesses went to very elevated levels, and the rest of the market was completely left behind. Following those two periods, we had really long small cap cycles. So following the Nifty 50 bust, we had a 10-year recovery cycle in the small cap market. Following the dot-com boom, we had a 8-year cycle for small caps. So this could be the start of a very long cycle of recovery for smaller companies, and we think that is a very exciting prospect. If you look at the valuations at the bottom, these are relative valuations. You can see there that this is the relative PE ratio of small caps versus larger caps. And you can see again that small caps are at a cyclical low from a relative valuation perspective. Small caps are very undervalued relative to large caps. Thomas, if you turn the slide to page 18, you can see that the discrepancy between smaller companies and larger companies is quite wide from the perspective of it's happening in multiple different regions. The US market looks like the widest discrepancy, where you can see that the S&P 500 is actually over 5 multiple turns above the small cap index in America. The FTSE 100 again is about 2 multiple turns richer than the FTSE small cap. And the same thing is happening in Europe with larger companies valued higher than smaller companies. Worth bearing in mind, of course, that smaller companies tend to grow quicker as well. So there is clearly a higher earnings yield achieved by investing in smaller companies than investing in larger companies. So we know that the discrepancy between small caps and large caps is pretty well recognized by a lot of the market. The question that we get a lot is, what's the catalyst? What will make smaller companies mean revert towards the long-term averages and for them to come back into favor? We think that there might be 3 catalysts. First of all, when we think about the larger companies, particularly in America, they have been growing really quickly, and especially in the technology sector. Many of these businesses have been growing for quite a long time at very elevated rates. And given the size that they are now, and several of them are actually approaching or have exceeded the $1 trillion mark, it is difficult, or history would suggest that it is difficult for those businesses to sustain those levels of growth. Competition will naturally come into their markets, and it will become difficult for them to continue to grow at the same rate. At the same time, those businesses are not priced for a deceleration in growth. And if there is any disappointment from a growth perspective, there very well may be a reassessment of how much money should be allocated to those companies. And if there is a reassessment, then it will be really beneficial for the rest of the market, just because of the sheer size of those companies. If you take, for example, the Magnificent 7 companies and you add up their market caps, it is almost 4 times the size of the entire US small cap market. So even if there was a small amount of money because of a change in sentiment that came out of the Magnificent 7 and went into the other parts of the market, including the small cap market, it would be a bit like trying to pour a bucket of water into a small cup. There would be an enormous amount of flow that would benefit the small caps and the other parts of the market disproportionately. So we think that could be one potential catalyst. The second catalyst could be cash flow deployment. We're already seeing in the small cap market that management teams are frustrated with their share prices and they are trying to take action. The way that they're taking action is that they are buying back their own stock because they genuinely believe that their shares are undervalued. So we are seeing more incidents of share buyback activity. The other cash flow deployment that we're seeing is from external companies that are interested in these businesses given the valuations they're at the moment. We're seeing M&A activity pick up. The chart at the bottom shows you the M&A cycle, and you can see that M&A activity year to date in 2024 is ahead of last year. Last year was a good year for M&A activity, but we still think that if we look at the previous cycles, that there is still a lot of room to run. We had 7 takeover bids in our portfolio in the financial year that just ended. And we think that a lot of the businesses in the small cap universe in general are undervalued. So there is scope for more M&A activity, and that will be helpful in the asset class coming back into favour. And the final catalyst I'd like to talk about is interest rate cuts. And Thomas, if you turn to slide 19, we can talk a bit about that. So we've had our first interest rate cut in Europe, and we've had our first interest rate cut in Canada. The expectations are that we might see interest rate cuts in the UK and in the US in the later part of this year. It's worth mentioning that interest rate cuts are more beneficial to smaller companies than they are to larger companies. And the reason why is that smaller companies tend to have less availability of credit and less access to credit than larger companies. A lot of smaller companies are also on floating rate debt. So when we have seen interest rate cuts in the past, small cap have tended to lead the market following the interest rate cut. If history is a guide, we've seen outperformance of over 10% by smaller companies relative to larger companies in the first 12 months after the first rate cut. So we know that the asset class is very unloved at the moment. It's underperformed. It's at a cyclical low when it comes to valuations. And we know that there are 3 potential catalysts: a change in sentiment, cash flow deployment in the form of share buybacks or M&A activity, and interest rate cuts. So I'd like to talk about the positioning as well, and how these markets move when there is a turn in the market. You turn to slide 20, Thomas. So it's quite well known that in small cap recovery cycles, it's the early moves that are the most dramatic. Because of liquidity, it does make sense to have some allocation to small caps, because when the move happens, it tends to be very fast. If you look at the past 5 cycles in the UK market, for instance, you can see that the recoveries, how much of the recovery happened early on. As the sheer volume of funds flowed into the sector, there was a dramatic move quite early on in the recovery. So it does make sense to have some money allocated to the sector to benefit from the recovery when it happens, because psychologically it is very difficult to chase a rapidly rising market. And of course, by having some exposure, you do benefit from the early gains, which tend to be the strongest. So I'd like to talk a bit about what we've been doing on the portfolio. So if we turn to slide 12. So we do think that we are in a highly uncertain environment at the moment. There is a lot going on. A lot of attention is being paid on to inflation, growth, and the outlook for interest rates. And we know that geopolitical tensions are elevated at the moment. So there are a wide range of different outcomes. The philosophy that we follow of trying to protect the downside, of taking a risk-conscious approach to investing in a faster growth asset class, we think that philosophy is actually quite well placed for the current environment, because our focus on protecting the potential downside, but then also offering the upside if the asset class comes back into favour, should benefit both ways. At the moment, we are cautious, but we are also opportunistic. We're looking to buy into quality businesses that can grow reliably. And many of the businesses that are listed here we think have got a long runways of growth and can grow reliably because they are backed by either secular trends or the end markets that these businesses are serving are very stable in nature, or these businesses have got recurring revenues. And as a result of that, many of these businesses can grow reliably whatever happens in the economy and in markets. The second area where we've been active is in cyclicals. We've been active in cyclicals which have very low expectations and very low valuations. And as a result of that, the valuations are protecting us on the downside, but at the same time, these businesses can offer significant recovery potential as the end markets come back into favor. Examples of industries that we've been investing in within the cyclical space are industrials, where we think the long-term outlook is really good because of trends such as decarbonisation, build out of infrastructure, and reshoring back to developed markets. And the other area is housing, where several housing markets across the world are depressed because of higher interest rates. But we think as interest rates are cut, those markets can come back. The final area where we've been active is commodity-related businesses. And these are high-quality businesses within a commodity-related industry. Commodities are interesting at the moment because of what's happened on the supply side. Many companies within commodity-related industries have shown a lot of capital discipline over the last 10 years. Many of them have not invested in new projects. They've instead focused on returning cash to their shareholders. And as a result of that, the industry is much more rational and supply constrained. At the same time, the demand outlook for commodities seems quite good from the perspective of many industries and are tackling decarbonisation, for example, which is going to require a lot of commodities. And many countries are investing a lot in infrastructure, which will require a lot of material. So we are positive on that sector, and we have been adding our exposure there. So those were the main areas that I wanted to cover with our audience today. And I wanted to leave plenty of time for questions. So Thomas, if we have any questions, I'd be very happy to answer some of them.
Absolutely. Thanks very much, Nish. We've got a few questions from the audience already, but if you're listening, please do add your question. We've got plenty of time. Perhaps we could just start. So Nish, you mentioned you've kind of only recently been appointed as the sole manager as of beginning of May, I think. Is there anything different about what you're doing now, about how you're approaching the portfolio?
Yeah. So I strongly believe in the philosophy and process that we have followed within this trust for a very long period. My predecessor, Peter Ewens, managed this trust for 19 years. And the philosophy is something that we have all bought into as a team. And we strongly believe in it. And we think that by taking a long-term approach, by focusing on risk, by investing in quality businesses, and by paying attention to the price that we pay for those businesses, those are evergreen factors of investment success, particularly in smaller companies. So our goal will continue to be the one-stop shop that provides the very best small cap opportunities in developed markets and in the fast growing emerging markets. So I think those things are the things that aren't going to change. What might change? So our company, our predecessor company, BMO Global Asset Management, was acquired by Columbia Threadneedle. The deal closed in November of 2021. We actually only co-located with Columbia Threadneedle last year. It is a much bigger organization. It is much more intense on research, and it has a lot more capability than we had before. So we are looking to harness the additional resources that we have within our organization. So, for example, last year, after a lot of deliberation and thought and conversations, particularly with the board, we made the decision to take half of our exposure in Japan, which was previously managed by third-party funds. We use third-party funds in Japan and in the emerging markets. We took half of our third-party funds that were allocated to Japan, and we allocated that to our internal fund managers at Columbia Threadneedle, who have a really good track record in Japanese equities, and who have a philosophy and process that is very similar to other parts of this investment trust. We are pleased with how that is going so far. Not only are we getting a very good philosophy and process, but this is also lowering the costs for our clients as well. So we will look for other opportunities to do something similar in other parts of the Global Smaller Companies Trust. We'll try and find a way to improve the proposition even more than it already is. It isn't a secret that the investment trust sector as a generalization is out of favor. Many trusts are on discount. We are also on a discount, and we have been more proactive, and we have ramped up our buyback activity in recent months. So we have historically, or in the last couple of years, we've bought back about 5% of our shares on an annualized basis. That pace of buyback activity has ramped up in the last couple of months, more towards the sort of high single-digit number. We have seen an improvement in our discount. We were actually at a 17% discount last year and earlier this year, and now we're hovering around the 10% level. So we're making progress on that front. And then the shape of the portfolio. So there are a number of holdings in the portfolio. We want to offer our clients diversification in what is inherently a riskier asset class. But we think that there is opportunity to perhaps reduce the number of holdings in parts of the trust. So we'll look to do that in a gradual and very pragmatic way.
Great. Quite a few questions on the portfolio, but perhaps very briefly, as you mentioned, the buybacks. One question on when you do buy back shares, what do you sell to fund these? How do you decide?
Yeah. So we obviously will look at the portfolio to see how many opportunities we have within each of the portfolios in terms of new ideas. Because this gives us an indication of where the value is in particular markets. We are very much bottom-up led. So right now we are seeing more in terms of the UK and Europe, and we're seeing less in North America. The valuation discrepancies are bigger in those two markets. So we have more allocated to those markets. So we're trying to take money from more expensive parts of the world and allocate that to areas that have got better value. And at the same time, we're also using some of the profit taking from those more expensive parts of the world, and even in securities that perhaps are fairly valued or overvalued, and using those funds to buy back our own shares, which are undervalued at the moment. I think you might be on mute, Thomas.
Well spotted. On the portfolio as a whole, so what do you think are the key advantages of investing with a global remit rather than allocating regionally through different funds?
So I think the attraction is that we can make decisions on where to put money and how to allocate in different regions just from our bottom-up analysis. So we have our finger on the pulse, if you like, of what's happening on a company level and how the valuations look. And we can, if you like, instead of clients allocating to different regions and making those decisions, we can make that decision for them based upon our bottom-up analysis. We also want the additional choice as well. We want to be able to access all of the world's markets and to find the very best opportunities within the small cap universe. And by operating in all these different markets, we can do that. And diversification as well by offering lots of different countries. We're offering a portfolio to our clients, which is small cap exposure, but it is sufficiently diversified from a risk management perspective.
How do you define market cap, or the limits for what can get into your portfolio? Does that vary across geography? And can you please tell us your approach to the concentration of the portfolio?
So it is very much on a country by country basis. So we will look to invest in the US market sub $10 billion. We don't really initiate positions in companies that have market caps above that. And that is still very much in the small cap arena, small to mid cap arena. And in the UK market, it is also governed by liquidity as well. So we wouldn't really invest in a company where we can't start a meaningful position. So in the UK market, generally, we don't tend to go below £100 million in market cap. Similarly, in US markets, below 200 is difficult for us. So that's the way that we think about it. We look at it on a country by country basis. The concentration level. So I'd have to come back to you on that in terms of exact figures on how much we've got in our, say, top 20 holdings, and then in the top 50. So that's something that we can come back to you.
213 holdings seems quite a lot. What is the rationale? Doesn't it mean that individual holdings can't deliver significant gains to the portfolio?
We think that we want to offer our clients sufficient diversification, but at the same time to be concentrated so that they are meaningful positions. There is a tail of holdings within the UK portfolio from a pure liquidity standpoint. We don't really want to go too much into the mid-cap space. So we do need a certain level of holdings to be able to be genuine small cap investors. So if we were to really ratchet down the holdings number, we'd start going into the mid-cap space, and we wouldn't really offer our clients the attractions of this faster growth asset class. So I think there's a balance between all of those factors. In the UK market, where we have got the most holdings, that's the market where we are likely to be reducing the tail down a bit to bring that number down. But that will be done in a gradual and pragmatic way.
And could you tell us the turnover typically on the portfolio, and if that changes over time, and also the geographic split? I think you touched a little bit on the current positioning, but is there anything to note there about how it's changed?
Yeah, so our turnover has historically been about 25%. We are very long-term investors. We have held a number of positions in our portfolios for over 10 years. The ideal situation is to really invest in a company that is very small, sort of sub 1 billion in market cap. And then if these businesses, if they've got really strong competitive advantages and generate very high returns, to allow those businesses to continue to compound. So those are the preferential investments for us. So we do tend to run our winners and have very long holding periods. We've got a slide in the deck on our current positioning. So if you go to page 9, slide 9, that gives you a good overview.
Yeah, got it.
Yeah, so you can see, as per my comments earlier, we are overweight the UK and Europe, where we're seeing the best opportunities from a bottom-up standpoint. Japan has seen a sea change in the last couple of years, where their corporate governance has improved a lot, and the companies are forcing change through hiving off or selling non-core divisions, and return on equity has become a focus of Japanese companies now. And we're seeing a lot of scope for re-rating in that market, so we are overweight there. In the rest of the world, the Indian market does look expensive to us. But at the same time, China does offer value. So we are underweight the rest of the world, and in North America, we are seeing fewer opportunities. So that's our positioning at the moment.
And now that we're on that slide, we had a question about other trusts and funds. So you've got the collective investment positioning there. Is this something that you would see increasing or decreasing in the years ahead? And I'd also be interested to add, when would you look at investment trusts rather than open-ended funds?
Okay. So we do have some investment trusts in those collectives. We have 5 collectives. So if you turn the page over, actually, that will show you our collectives. So we were actually 7 collectives about a year and a half ago, and we were 25% of the portfolio was in collectives. So we have brought that number down to 5 and to 18.5, and there is potential for that to go down even more. In an ideal situation, we would limit our exposures to the emerging markets for our collectives exposure. And the reason why we've gone down this path is that investing in emerging markets is very much a specialty discipline, and especially in emerging market smaller companies. A lot of things can go wrong in small cap equities in the emerging markets. You have to have a high degree of infrastructure within those markets to do a good job. You have to know the management teams. You have to be very familiar with the conventions, the accounting, the languages, be able to travel to remote parts of the emerging markets to do a really good job in that space. So we think it's a highly specialist area. And at the same time, we have got very good capabilities within Columbia Threadneedle to choose the right funds through our multi-manager teams in Boston and London that have got data-rich analytics and are able to support us in selection of these emerging market funds. We regularly meet with these companies, and we know all of the funds that operate within this space in order to make decisions on which ones to include in for the Global Small Companies Trust. So I think the direction of travel is that the collectives are coming down. It is not a huge part of the overall trust, and we have capabilities within Columbia Threadneedle to choose the right funds in this highly specialized area.
Changing tack a bit, in relation to your idea of quality, do you have any explicit inclusions, such as maximum level of leverage, for example?
Historically, we have found companies, there are a whole host of different things when we think about leverage. So a business that has highly recurring revenues, visible cash flows, very stable in nature, can take on more leverage because it is able to service that leverage. But even then, what makes us conscious about leverage is the things that you don't think about that suddenly hit you as a company and mean that you have to survive for an extended period of time when trading conditions might be difficult. Case in point would be the pandemic. No one saw it coming, and suddenly, if you had a levered balance sheet, you were put in a very difficult situation. That makes us wary of leverage because it's already a risky asset class, We don't want to amplify the risk by investing in companies that have levered balance sheets. And it varies by market as well. In the US, we tend to not have businesses that have over 3 times leverage on them. But that number is 3 times would seem quite high for a UK investor. And actually, in our UK portfolios, we don't really have a lot of companies that have over 2 times leverage in them. So it varies by region, but from a region-specific standpoint, we have lower levels of leverage when you compare to other smaller companies operating in those markets.
Brilliant. So I'm going to put out a last call for questions. I've got one more here. If there's something you'd really like to ask Nish, please put it in the box now. On the US, the largest US stocks have outperformed, arguably because their fundamental returns have been better than small caps. Why would that change?
So, to my earlier point, these companies have done a phenomenal job of growing their earnings and growing their sales and generating high returns. The problem that they're going to face, I guess, is that they will come up against comparisons that are very tough. It is extremely hard to carry on growing, in some cases over 20% a year for an extended period of time. And if your shares are pricing into perpetuity that you'll carry on growing at that same rate, you are somewhat setting yourself up for disappointment if you don't deliver. And some of these companies are because they're generating such high margins, invariably you will see competition. And you are starting to see that. Many of these businesses are starting to see other competitors come into their areas to try and claim some of the profit pool that they are taking. It's the nature of capitalism that a lot of companies, that competitive advantages tend to get competed away over time. We have seen this in the past where a group of companies might dominate a particular market for a long period of time, and then the leadership changes. So, in the 90s, famously, the technology businesses did extremely well. But then in the 2000s, it was more about the commodities and the financials that did really well. And then technology came back into vogue in the 2010s and the early part of the 2020s. So these things do trend in cycles. And we don't expect that it will be different in the future based on a really long history of how capitalism and businesses generally work.
Brilliant. That seems like a great ending note, really. So thanks very much, Nish, for your presentation and for answering all those questions. Thanks very much to you in the audience. We hope you'll join us tomorrow, where we'll be focusing on the UK with Mitre and UK Microcap at the same time. But yeah, thanks once again, Nish, for a great presentation, and have a great day.
Thanks, Thomas, and thank you to our audience for your interest.
Bye, everyone.